Hi, my name is Shreyans and welcome to this series where I do a basic high-level financial analysis of different companies. The objective here is not to directly make an investment decision, but to shortlist companies for investment purposes based on the financial fundamentals of the company, right? So we are going to start with the different companies of the Nifty index, and today's company is Adani Ports and SEZ. So the company does port operations and it also provides logistical services, and it is the one of its kind company that's there at least in the Nifty. So there are other companies that operate port, but they are quite smaller, and Adani Ports is the only kind of its company in the Nifty index. So we look at the highlights later, but first let's start with the financials of the company. So here I have 10 years of high level financial data. I've taken this data from RateStar and Screener. So this might not be exactly the data that was reported in the annual report, because these websites, reclassify data as per their own presentation, but it still gives a very good idea. So let's start with the P&L items. We have revenue, EBIT, and PAT here. So as you can see, the trend in revenue has been upwards, and it has up almost 5.7 times in a 10-year period. So that's a very solid growth. In fact, if you look at the revenue growth here, it has been very solid, except for the recent 2 years, with a median growth of 27.4% and a CAGR growth of 21.4%. So that is a very healthy growth rate. And similarly, you can see that the same trend can be observed in EBIT and PAT as well. So EBIT and PAT have not grown as strongly as revenue has, right? But still the growth has been very solid, right? So you have CAGR of 15.3% in EBIT and a PAT CAGR of 17%. So, I mean, that seems at least very good, right? The concern here with the year-on-year performance here is that the poorest performance with respect to the revenue, EBIT, and PAT has been in the recent 3 years, right? So if you see, revenue went down in FY19, slight recovery in FY20, right? And the FY20 revenue is just slightly greater than the FY18 revenue, so it's more or less on the same lines. Similarly, EBIT has decreased for 2 successive years. Here it was a relatively small decrease, but here it has gone down by almost 1/4, right? And PAT went down in FY18, recovered slightly in FY19, and then it again went down in FY20. So again, what you would see is that FY20 PAT is slightly greater than the FY18 PAT. So this is a slight concern here, right? That the most recent 2 years performance has not been as good as the historical 8 years worth of performance, right? And I don't know how the performance would be in FY21, considering the impact of lockdown and suspension of commercial operations, right? Because a lot of commerce was suspended due to the lockdown and due to COVID. So it would be interesting to see the FY21 numbers that the company puts up, right? Now let's move on to the cash flow items. So here I have the aggregate, the cash flow from operations, cash flow from investing, and cash flow from financing. So cash flow from operations has been greater than PAT in majority of the years. And if you here also look at the accumulated CFO and accumulated PAT, right? So accumulated CFO is around 33,500 CR, and the PAT is almost 26,000 CR, right? So the CFO has been pretty solid versus PAT. So this might indicate that there might be, non-cash expenses, and there might be interest charges as well, right? Which are dragging down the PAT, but the cash is pretty solid. Then with investments, so as you could see, the company has kept on making significant year-on-year investments, right? This might indicate that it is a capital-intensive business, right? As you will also see in the non-current assets later. Moving on to the cash flow from financing, right? So here the company had significant inflows. Here also the company had pretty good inflows. And if you look at the non-current liabilities also kind of increased here, right? So I might suspect that this has a lot to do with borrowings. And in these years, the cash flow from financing might look optically lower, right? Compared to the few other figures that we have. But this might not be the true picture, because this is the net amount. This is the net of financial inflows and financial outflows, but the absolute amounts which would be much greater. And what I suspect that there would be repayment of borrowings and then issue of new borrowings, or then they have raised new borrowings, right? So it would be interesting to look at the breakdown here, because I mean, it doesn't work that the company has a very long-term borrowing. It doesn't have to pay back its money, but I think it is paying back money and it is raising new external capital, debt capital as well. right? Equity has grown also at a very healthy rate. This is the book value of equity that we have here, so it is up by almost 6 times in 10 years. So that seems pretty solid. Then we have current assets here. So this is also very interesting, right? Because current assets are up almost 19 times in 10 years, but if you see the last 3 years, it has more or less been around the same. It's within a specific range. So practically in 8 years, it has gone up by almost 19 times, right? And I suspect that this has to do with the influx of cash through borrowings, right? Because cash goes into the current assets, right? And so as borrowings increase, the cash balance also increases. So the company might have cash balance based on that. And I checked that there were also some short-term loans and advances. So I think the increase in cash due to borrowings, especially due to borrowings, apart from the usual cash that is generated from the operations, and some short-term loans and advances, which were offset by the decline in other current assets, right? Again, as we see non-current assets have significantly kept on increasing because it is very evidently is a capital intensive business. Because if you look at the revenue here, revenue is about 11,500 CR, but here the non-current assets are almost 46,000 CR. Now, obviously, not all of the non-current assets would be fixed assets that the company uses for its operations, but still, that a significant portion of these would be the fixed assets, and they are significantly significant. They're in fact in a multiple of revenue, not just greater, but a multiple of revenue. So this might indicate that it is a very capital intensive business. With current liabilities, I mean, they have broadly followed the trend as per the operations, right? Here, this was 1 year where it was it was very high, and here also it seems quite high, right? But I think that this has to do with the reclassification of the non-current liability to current liability, at least the portion which would be payable which would be payable within the next 12 months, right? Apart from the usual current liability. So I think that would be the one item that has led to this sort of significant bump sort of here, significant bump here, right? So we've almost more or less looked at the growth rates of different. At least we've looked at revenue, EBIT, and PAT. Very good growth in almost 8 years here. Slightly poor performance, actually quite poor performance in these 2 years. PAT has been CFO growth has been slightly volatile, right? Because obviously the operating cycles don't always collide with the financial years, but broadly it has been very good. And if you could see that the CFO here has grown by 22.3% versus a 21.4% growth in revenue, a CAGR growth in revenue. So it seems pretty plausible. Then we have equity as well. So equity has more or less grown, consistently grown, right? As we saw here as well. Right. Now, assets have also continuously kept on increasing except for 1 year here, right? So current assets have also increased, non-current assets have also increased, and that seems pretty obvious. Now here I have a growth rate of current assets less current liability. So what we could call it here as net working capital, so to speak, right here. This is something that I've calculated here. And if you look at the current assets less current liabilities, it has been negative, then it has been positive, again negative, then it has increased very highly in these 4 years. And again, I think this might have a lot to do with the cash influx that was there. So the range here is very, very varied, right? Because the maximum difference here is almost 10,000 crores, and the minimum here is a negative of 1,700 crores, right? So this has been slightly volatile, and this is something that you would see here as well with respect to the change. The liabilities have grown overall at a 23.6%, so which seems more or less okayish, right? But then we'd also have to take a look at that what is the absolute amount of debts and not just the growth rate of debt, right? Finally, let's get on to the metric section. So we have return on capital and return on equity here, and we do a breakdown of this into the margins and the asset utilization that I have here, capital turnover and asset turnover. So if you look at the broad trend of ROCE, it was more or less operating in a range here, and then it has suddenly fallen here, except for this year, which was very low, right? So the return on capital of 7.2%, it's the second lowest that we have, right, in the most recent year. And return of equity of 14.7%, it's the lowest ever, right, in the 10-year history. So, and one interesting thing that you'd observe here is that the return on capital is actually lower than return on equity, right? But usually equity holders are the last in line, but a fixed payment has to be made to the external debt holders, right? So this is where leverage comes into play, right? So the companies able to increase returns to its equity holders because it is paying a fixed rate of return to its debt holders, right? So this is something interesting to see. But yeah, the broad trend has not been very favorable, at least in the recent years. As you can see, it's sort of declining, right? So now let's take a look at that. What is making these figures as they are, the return on capital and the return on equity figures? So we have an EBIT margin here, and it's a solid EBIT margin, right? It's more or less operating in a range of 5 to 6 percentage points. But again, as you see in the most recent year, it has fallen uh, by almost 1/3 compared to the previous years, right? So this is something that needs to be looked at. And even the PAT margin is also very solid, but the broad trend has been of decline. It has declined, then it has shown some resurgence again to previous levels, but then it has again declined. So this has been sort of a trend of up and down, right? But overall, also these margins seem to be pretty solid, right? But the concern here is with the capital turnover and the asset turnover, right? So this is basically the utilization of the assets or the capital to generate revenue. So capital turnover is revenue by capital employed, and asset turnover is revenue by assets, right? And here, as you can see, it's fairly low. In fact, if I look at the aggregate, then there is only just 1 year where it is even greater than a quarter. So what this basically means that in order to generate it has to have $1 or 1 rupee worth of capital to generate 22 paisa worth of revenue, or it has to have 1 rupees worth of assets to generate 19 paisa worth of revenue, right? So this is basically an indication of highly capital intensive businesses. As we also see here, that this is the amount of non-current assets, right? So this is the total assets, almost 61,000 CR, and the revenue that they generate using those assets is about 11,400 CR. So that is highly capital intensive. So this is basically what is dragging down the return, right? So the margins are very solid, but because the capital turnover, right, it is unable to make best use of its resources or the best uses of its capital. Now, a lot of this might be due to the nature of industry itself as well, right? Because it might have to make significant investments into the logistic vehicles and port operations as well, right? Due to which it is just not possible to have very high capital employed ratios as well. So, but this is one thing that is a cause of concern, and I'll again take a look at this when we discuss the highlights to share something very interesting. We'll relate it to how this basically translates into how where the company gets its capital to invest so much, right? As we talked about the CFO and PAT here, so very solid CFO and PAT. There are only 1, 2, and 3 years where the PAT is actually greater than the CFO, and as we looked at there as well, that the cumulative CFO is greater than the cumulative PAT. We've already discussed current assets and current liabilities, and this is something how it is. And finally, we have the non-current liabilities to equity, right? So this was significant here, and it has like kept on declining. Then it has again increased here. It's about 1.07 to 1. So the non-current liabilities are about 27,455 CR, and the equity is about 25,600 CR, right? So that is there. And the asset upon equity here is 2.38 times. So this is what I was talking about, right? So although the company has low return on capital, but because it is has this leverage due to which it is able to increase the return to its equity holders, right, at the cost of fixed rates being paid to the debt holders, right? So it is about 2.38. So what it basically means is that for 2.38 rupees of assets, 1 rupee worth of asset is financed by equity. The remaining 1.38 is financed by debt. Right. So this is a more or less basic financial overview, and now let's discuss the highlights. We'll go point by point, right? So as we saw, very strong growth in revenue, EBIT and PAT, except for the recent 2 years, and the next year also is questionable that how good will it be. Strong cash conversion, as we saw, CFO is greater than PAT in 7 out of the 10 years, and even the cumulative figures, we know, and significant borrowing repayments and new borrowings raised in the recent years, which is what I talked about here, that the CFF might look optically lower, but this might not be the case. If you go and look at the breakdown of the cash flow statement, you realize that there is significant repayment of borrowings and also new borrowings being raised. The current assets, as we discussed, have increased by almost 19x in 10 years. right? With the influx of borrowings, cash also comes in, and there have been some short-term loans and advances also that is made by the company. So it would be interesting to see that where have these short-term loans and advances been made to, right? Because Adani is a group, and it is possible that it might have been made to other group companies, and this is something that we need to see. That has technically increased 10x in 10 years versus a 6x increase in equity, right? So you can see that where is the majority of capital coming from. As we talked about, return of capital greater than 15% in only 1 out of the last 10 years, but return on equity greater than 15% in 9 out of the last 10 years, and which is because of the financial leverage that the company has. Pretty solid EBIT and PAT margins that we discussed here, right? Greater than 30, great EBIT margins greater than 40% in 9 out of last 10 years, and PAT margins greater than 30% in all of last 10 years. But the performance of the recent 2 years haven't been the most promising. All right, that is something that we have to see. Capital turnover has been less than 0.25x in 8 out of the last 10 years, which is basically what is dragging down the return on capital. Now, this is the most interesting point that I want to discuss, right? Which is it is a highly capital intensive business such that cash generation doesn't meet capital requirements. And let me illustrate the point here, right? So basically what we have here is that a capital turnover of 0.22. So what this basically means is that if I have a revenue of 2 rupees, that means my capital invested into the business is what? Is 10 rupees, right? So for 10 rupees worth of capital, I'm able to generate 2.2 rupees of revenue, right? And now if you look at the margins, right? So here, and not just the margins, let's rather look at the cash flow from operations. So if you look at the cash flow from operations, so it's almost half of the revenue. It's not exactly half, slightly less than half, but let's consider it as half, right? So, sorry. So if I've generated 10 rupees worth of revenue, sorry, 10 rupees worth of capital, if I have 2.2 out of that is revenue, and half of that, which is let's say 1, slightly lower than that, or let's just even say 1.1, this is my cash, right? Now if I want to grow, then I need to invest practically 5 times the capital in order for my growth revenue, right? And I am not generating enough profit here, which is why the company has to keep on raising the debt. And if you see that the debt has significantly kept on increasing to the point where practically the debt is even greater than its revenue, right? So it is a continuous cycle of keep on raising capital in order to fund the expansion that the company goes through, right? So this was a basic analysis of the company Adani Ports and SEZ. Now you need to decide whether you should study the business model of the company, and if it is going to go through significant changes that might lead to even better financials, especially on the return on capital side, right? So this was my basic overview of what I feel that we should understand about the company, right? If you found this helpful, then please let me know. If you have any questions, or if you want to discuss more about the company, then please message me directly and I'd be happy to have a chat. If you want to receive analysis such as this directly to your inbox, then you can sign up using the link in the description. Or if you want to take a look at this workbook as well, then you can find the link to the workbook in the description below. So this was it for today. I'll see you again tomorrow with another company of the Nifty index, right? So if you want to receive updates for that, please subscribe. If you found this helpful, please share and let me know. Thank you so much. I'll see you again tomorrow.